Hey guys, Max here, and this is your daily market update for yesterday, the 14th of January. There was, of course, a lot going on, a very volatile day, and actually a week for markets. Some new data emerged with the US regarding their economy, and it just wasn't very good, and then just a couple other things to mention as well, so let's get right into it. Now, what went on with the markets then? Well, it was a crazy day, and as is so often the case right now, stocks rose, then fell, then rose again, then fell again, and then finally rose to finish about 0.5% up on the day. The S&P closed in pretty much the exact same place it started the day, but the Nasdaq did very well and closed up 0.7% for the day. The Dow Jones did far less well, falling 0.6%, and the MSCI World Index didn't do too well either, falling 0.4%. Bond yields saw a pretty crazy advance across the board and across oceans as well. The US 10-year Treasury rose 8 basis points for the day, which is a lot, leaving it at its highest point in over 6 months. Britain's 10-year yield rose 4 basis points, as well as did Germany's 10-year. The dollar did decently, with the spot index rising 0.2% for the day. Oil saw a decent spike, up another 2.7%, which is of course on top of the already high prices we've been seeing. WTI crude oil is now sitting at about $84 a barrel, which is obviously bad news for inflation. Prices are not falling as many people had been expecting them to. We didn't see much happen in the crypto markets. Bitcoin is still sitting at around about $43,000. Ethereum is up a little bit at $3,300, and the rest of the altcoins saw slight increases, most up something like 1 or 2%. Dogecoin saw that little spike, but then dipped a little bit, but is mostly holding onto those gains it had from the day before. This is, of course, all based on that Tesla news. To be honest, people calling this a win are a little bit out of touch in my opinion. Ever since the original Dogecoin pump back in early 2021, Dogecoin has been on a downwards trend, and it's been getting beaten out by every other crypto, and this little pump doesn't change that at all. Now, markets have obviously been very volatile recently to a ridiculous degree, and it really isn't always clear why they're moving in certain directions, and I hate to say it, but yesterday was kind of one of those days. There are some ideas behind why markets moved in the way they did, but none are really too convincing, to be honest, and no one seems to agree on what really happened. Obviously, tech stocks did well comparatively, which would imply that maybe interest rate fears have been reduced, but I haven't seen anything that might suggest that's actually the case. In fact, in my opinion, the prospect for interest rate rises got worse, not better, with Jamie Dimon, the long-term CEO of JP Morgan Chase, when he came out and said that he sees as many as 7 interest rate rises in 2022, which is far more than is priced in by the markets. There's a chance that investors are just growing more confident in companies' abilities to perform well in a high interest rate environment, but I think that belief is unfounded and just wishful thinking. Now, of course, there is a lot being said about the tech rally yesterday, but the performance of these stocks, or these type of stocks, has still been pretty dismal for the first part of the year. Once again, it's easy to just concentrate on the mega caps, the Nvidias and Microsofts and the like, because for the most part, they carry the Nasdaq index. Now, these mega caps are, again, for the most part, seeing really strong performances, and most of them are in positions where they aren't absolutely reliant on cheap capital to grow. Apple generates tens of billions of dollars in profit every year, and the simple fact is they don't need to release company bonds or take out loans to finance growth, and similar stuff can be said about the other mega caps as well. On the surface, it doesn't look too bad for tech, but dive down a little bit deeper and it quickly gets far, far worse. Take a look at Peloton, a company who was once the baby of plenty of investors from Cathie Wood to Meet Kevin. Well, it's seen such a spectacular fall from grace that it's just been dropped from the Nasdaq 100 after seeing an 80% decline from its all-time peak. The Nasdaq index is only down about 8% from the all-time highs it saw in November, and that's not even enough for it to be considered a correction. It's also a trend that has only lasted a couple of months. November was not too long ago now. But the problem is that, as I just said, the index is being carried by the big players, the mega caps, who have done really well, and that's hiding the failings of all the other companies. Over 1/3 of the companies in the Nasdaq are down 50% right now. A 50% crash, and over 1/3 of the companies in that index have seen that over recent months. 36% of the companies in that index are down by half, to be precise. And if you try to think of that in some other circumstances, it quickly becomes clear how crazy that number is. Imagine if the index as a whole were down by that much, or if the S&P 500 were down by that much. That would be a crash that would terrify the entire world, and there would be no respite from those claiming that we would never see the markets recover. But maybe you say, maybe this is just the way the Nasdaq is. It's always had those volatile, innovative tech stocks that rise and fall crazy amounts, and this could just be normal for that kind of company. And well, to be honest, history would disagree with you. By looking at historical data, we can see what happened in the past and so what we should expect today. Now, in the past, when the Nasdaq has been down by about 8% from its all-time highs, we would expect to see about 10% of the companies in the index fall by about half. But unfortunately, we are 3.5 times worse than that. Now, some analysts are claiming that this is just a standard cyclical shift and that it won't last any longer than a few months, but there are people saying that this could be showing the peak of the bull market. Now, when we look back on something like the dot-com bubble, we often forget, but the bubble didn't pop and instantly collapse. The highest risk, most hyped up dot-com companies fell first, and they fell gradually. Then, after 6 months of this, a year of this, the less risky but still heavily growth-oriented companies started to fall, and in the end, this valuation shift ended up hitting the entire market. It took about 2 years for this process to take place, from peak to trough, but because of the fact that we call it a bubble, because that's the word we use, that term makes us think of a singular moment where everything crashes 50%. Lots of people have it stuck in their minds that that's what's happened, but it just isn't the case. Now, just like Pets.com and Netscape went on to characterize the dot-com bubble, I think Cathie Wood will characterize this one. She had a crazy good time of it, riding up on the hype and beating pretty much every other institutional investor for a year or two. Lots of this was carried by her early Tesla bid, but she did have some major other wins as well. The problem is, those times seem to be long gone. Her funds lost about 40% across 2021 as a whole, and 2022 doesn't seem to be looking much better either. Across the mere 15 days that this year has seen so far, Cathie Wood's flagship fund, ARK, is now down 17%, and from its all-time high, it's down about 50% as well. Of course, her fund has already become sort of a benchmark for overhyped tech stocks with crazy valuations and cult-like followings, the exact same companies that have been dragging down the Nasdaq as well. And unfortunately for her, her investors are starting to pull out. On Wednesday alone, $350 million was pulled out from her flagship fund, ARK, which may not seem like a huge amount considering how all of her funds combined hold about $25 billion, but that is just over 1% of her capital disappearing across just one day. It's not a small amount, and by all accounts, her ARK is sinking. Now, of course, there was some data that came out from the US yesterday, and it was highly anticipated because it was data that would directly indicate to us how the American economy is faring and how American people are feeling. It was, of course, US retail sales and consumer sentiment reports, and sadly, neither came out very good at all. As 2022 ended, US retail sales actually decreased. Now you might say, well, it's January, so of course people are going to spend less than they did in December. December is the big month, holiday bonuses, Christmas presents, and traveling to spend time with family and friends. The only problem, of course, is that this is data for December, and I can't stress how important this is. Retail sales fell 1.9% during December, the strongest month in the year. This is not good news, and to back it up, we have consumer sentiment reports, and on that front, it isn't good news either. Consumer sentiment is now far lower than it was during the peak of the coronavirus lockdowns. I mean, absolute peak as well. Every country in the world shutting down borders, no planes or ships going anywhere. Schools closed, workplaces closed, essential shopping everywhere, lockdowns for months, and consumer sentiment today is worse than it was back then. Of course, there are analysts making excuses for all this. They claim that people did their Christmas shopping back in October, and so the retail sales falling isn't a big deal at all. They're claiming that the Omicron variant caused people to stay at home and live in fear, but they said the exact same thing about the Delta variant 6 months ago, and it turned out to just not be true at all, and I fear the exact same thing today. Now, poor consumer sentiment is something we've been talking about on this channel for as long as we've been talking about inflation, and there's a reason behind that. Consumers hate inflation. It terrifies them, and rightly so, because they see the cost of living rise every month while their pay tends to stay stagnant. What sane person wouldn't be scared by this? People spend less money when they see this happening. They make cuts, they make savings, they prepare for trouble, and that in and of itself can often go on to create trouble. But make no mistake here, consumers are not at fault for this. The United States government and other Western governments as well, central banks all over the world, every single institution that sanctioned this ridiculous money printing that we saw over the last 2 years, they are at fault, and they are the cause of this crash in consumer sentiment, and they are the cause of the coming recession. Omicron is just an excuse being used to avoid taking blame, just as Delta was a few months ago. Try to look through what you're being told. Think critically. Did people buy their Christmas presents 4 months in advance because they predicted a new variant emerging and that the threat of that would mean you couldn't shop in December? No, of course not. That just didn't happen, but we are now being told that it did. What this data shows us, all in all, is that the economy is not as strong as we've been told, and there may well be tough times ahead in 2022. A hawkish Fed, though, is still necessary. Delaying rising interest rates further would just cause more hardship down the line. The tough times to come, they are necessary because of the easy times we've had over the last 2 years, and the next time the government tells us they want to give us those easy times, that they want to start printing money again and handing it out again, we need to remember what it really leads to. Now, in less serious news, Martin Shkreli, the old king of Wall Street's bets, has been permanently banned from the pharmaceutical industry. He obviously became pretty famous years ago for being the most hated man in America after hiking the prices of life-saving drugs, and unlike what most pharma executives do, he didn't pass blame or claim that price hikes were necessary. He literally said his role was to maximize profit for the firm he was running, and that's what he attempted to do. He ended up going to jail for price fixing, but before that he was on Wall Street Bets as basically their mascot. He had a YouTube channel and gave an insight into how the industry worked, but mostly he just messed around online and had a lot of fun. Now, this was long before Wall Street Bets took off in 2021, long before it became all about short squeezes and loss porn, and it isn't really anything like it used to be anymore. Everyone I know who used to follow that subreddit, because I used to follow it as well years ago, they don't really bother with it anymore, and neither do I. Anyway, he's going to be getting out of jail soon enough, but won't be able to return to that industry, which, let's be honest, is probably a good thing for humanity. Now, tensions in Ukraine and in Russia are getting worse, not better, as some new developments have emerged, including undercover Russian operatives who are getting ready to attack Russian forces as a false flag attack to justify starting a conflict. Russia also just carried out this huge cyber attack against over 100 Ukrainian websites. In short, things are not getting better, and I'm sorry to annoy the people who seem to be taking the Russia side here again, but Russia is categorically the aggressor here. There is no question about it. Ukraine very clearly just wants to be able to live in peace and go in the direction they want to, and they should be allowed to do that. Russia has this utterly deluded idea that Ukraine is part of Russia's sphere of influence, so they shouldn't be able to do what they want, and this is basically neo-colonialism. I do get some people saying that I'm clearly biased against Russia and China and towards the UK and the US, as if I'm not critical of our own governments enough. The truth is, though, I talk about the corrupt nature of American politics far more than I do about Chinese or Russian politics. It just so happens that China and Russia are awful states almost in their entirety, and this Ukrainian situation is a brilliant example of that. Now, that is pretty much it for the day. I will see you all again tomorrow. I'm afraid I'm going to have to miss a few days next week. From the 18th through to the 21st, I'm going to be out of action, unable to answer any messages as well, and of course no videos, so I apologize in advance for all that. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world-famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.